Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Ross Clark from CIBC Wood Gundy is our guest. Ross, it is always good to talk to you, and it's great to have you back on This Week in Money.
Yeah, it's nice to be back. The end of the summer here, and everybody looking to send us kids back to school and gear up on the investment side of things.
Looking forward to the Labor Day weekend, and the big news today, of course, Ben Bernanke, and a great headline from Business Week this morning. Bernanke refuses to rule out more easing.
Right. I mean, they continue to tell us to watch the data points. If the economy gets weak enough, they will pull out more triggers and find a way of stimulating to some degree. We all know that the end game here is one that is in question, and the ability to stimulate is something that we just haven't seen much follow through on these days.
Yeah, got to remember that this is just a speech. The actual Fed meeting, the FOMC meets September 12th and 13th, so 2 weeks away from any further hints of stimulus. What's the talk today doing to markets?
Knee-jerk reaction initially. You had a bit of a pullback, and then the market took off very well into the middle of the morning. We had the Dow up about 150. We're up 60 points right now. Toronto market coming back. It's up about 63. Was up maybe around 100 at the best point of the day. Big action as far as the currencies and precious metals are concerned. At this point, we've ended up with just under a $40 range in the gold market, and up $27 on the day. Silver market, the same type of volatility. Trading range of better than $1 and about $1.20 here, and up 98 cents on the day.
Got to remember that most folks are still on vacation. Not many bears or bulls are on the markets, mostly sheep.
Mostly sheep. Volatility has been reasonably small. Nobody wanting to take big positions ahead of news, whether it be out of the Fed or out of the Europeans over the next couple of weeks. And not only volatility, but volumes very, very light. But the U.S. market has been just creeping its way up. The last number of weeks had small corrections. I think in terms of the S&P, which currently sits at just over 1,400, we've got some still reasonable targets at the 1,440 level. I wouldn't be at all surprised to see the market try and test those.
Most of us, of course, just getting back from the beach or the lake or weddings or golf, and now we're starting to think, gee, it's Labor Day, it's coming up in September, and we're starting to think about investment in markets and what's going on. Well, what do we look at going forward in September?
Well, we've talked about this earlier in the year. In terms of the seasonality in presidential election years, you will get one and sometimes two sell-offs during the second and third quarter of the year. We had the first one this year down into the middle of June. There's a very distinct possibility that once this market sort of runs its course on the upside here, that we would get another one of those corrective processes, maybe in the 5 to 10% bracket, taking us down prior to the election. What you need to watch is following Labor Day, in the strong years, in presidential election years, the corrections are pretty mild, giving back normally about maybe 60% of the gain that it would have had from that June low. And in years where it starts to really come unglued in the second half of September and takes out that type of support, you can end up with some pretty nasty declines. But in general, markets tend to stair-step their way up from the summer of an election year right through the summer of the following year. So the key here will be to see how well we hold on pullbacks more than anything else.
Ross Clark from CIBC Wood Gundy with us here on This Week in Money. Let's look at commodity markets, oil and gas, gold and silver. General theme here seems to be a correction coming. Let's start with oil. It's up just over $96 a barrel today.
Yeah, we're up to levels that we saw a week ago. Oil has rallied from $77 in June up to $98, backed off to $94. The work that I do suggests that the weekly charts are into an important resistance level here. We've retraced just over 60% of the decline from the high earlier this year at 110. So 110 down to 77, back to 98. That's your 62% retracement. And looking at the number of weeks and counting, we have a pattern, a sequential pattern here that I talk about on the charts that I have for people. Very rare pattern here would indicate that we are probably within 1 or 2 weeks of an interim high in oil, and we could be seeing a pullback into the $87 to $90 range. I would look at that as a reasonable support area, and if it holds there, then look for a pretty good fourth quarter of this year.
Russ, we also had a great month for gold. Started the month at $1,600, and it's up $80 today.
Yeah, thanks to Bernanke and Company that say where they're not doing anything today, but they were not going to rule out stimulus. From our perspective, you were in the middle of a seasonal window that's usually quite good. From a July-August period out into October. My work shows that you typically will have one first rally that will have then a pause, and you'll get a second rally. From the perspective of price levels, we are sitting now about 1685. And the important resistance that we think we're working towards is in the 1690 to 17.25 level. That I think will be a pretty big overhead for the market right now. Within the complex, what we've seen is that for the last month, silver has been stronger than gold on the way up. As an example, today silver is up 3.3% on the day. Gold's up 1.7%. That's what you tend to see in the strong markets in terms of precious metal. That's what we saw in the first quarter of last year when we had that great run up to $50 in the silver market. So right now, silver's outpacing gold, but the caveat here is that when we look at the ratio and we take a look at how overbought or how oversold it is, we're getting towards an extreme that will probably produce a correction. So I wouldn't be surprised that not only with the crude oil are we probably looking for a short-term high in here, but I think in terms of the precious metals, there may not be all that much left on the upside of this run.
Silver really the star of the show here, up from 27.5 to 31. And look at platinum and palladium; they're also going nuts.
Yeah, platinum and silver actually were the first two to break out the Monday of the previous week here. And it was a day or two later that the gold broke out. So they've been leading the parade pretty well.
How do we position ourselves, Ross, for what's going to happen in September, October?
Well, I think we need to be cautious in here. Probably look for anybody who's trading. You want to maybe pull up your stops reasonably tight. Make sure that these moves we've had up off the low, that you're locking in some profits on them. And if it looks as though things are starting to roll over, there are some nice bear funds out there or inverse funds. I'd stay away from the leveraged ones,
okay. The triples,
the ones that are 2 or 3 times multiples of the indices. Just stay with the normal inverse funds and be there. And you want to stay away from as many of the speculative items, and keep the account back to the staples and items that have got good solid dividends with them.
Now, as volumes return to normal, it's a little easier to chart the direction of markets, I assume, in September, October. Or have they been thin all year long?
No, it's the volumes really started to come off fairly dramatically in April, May of this year, and they've just stayed down. I think this thrashing process that we've been going through with headline items, say from a monetary aspect, that are sitting out there, and reasonably soft economic numbers, they've just kept people in general away from the marketplace, at least the traders, those who are in for the long pull, and they're not interested in trading their positions. Why move the positions around if you haven't had enough volatility to produce a decent profit?
Okay, quick prediction here. Bernanke comes out in 2 weeks. The FOMC meets and says, yes, there's going to be more stimulus, another couple of $1 trillion. What will that do?
Oh, well, every one of those packages, has had definite impact in terms of the marketplace, in terms of pushing it, but each one has had less impact.
Yeah.
You probably see the market do well in the initial days afterwards, but I wouldn't jump on the bandwagon with both feet and anticipate a runaway market. You would just know that you are going to have the Fed behind you with a policy that would be supportive to the trend. But as I say, don't look for a gain such as we saw in 2009 or 2010.
Ross Clark from CIBC Wood Gundy. And if you would like a copy of the charts we talked about today, that's easy. It's ross.clark@cibc.ca. Or we could always call you. How about a couple of phone numbers, Ross?
The direct line here in Vancouver is 604-661-7759, or toll free at 1-877-331-5122.
Ross Clark, always a pleasure. Thank you, sir.
More than welcome, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
Sean Brodrick is editor of Red Hot Global Resources and Global Resource Hunter from Weiss Research. Check out Sean's blog at uncommonwisdomdaily.com. Hey, Sean, it's always good to have you back on This Week in Money.
Thanks very much for having me on. These are exciting times, so there's a lot we should talk about.
Big news this week, Ben Bernanke leaving the stimulus window open but didn't actually jump through it.
Well, yeah, and this market lives on hope.
Yeah.
So it's actually a very smart move for him. However, I think the closer and closer we get to the election, the harder it will be for him to actually do any stimulus. But he's giving the market hope that it will, and now everyone's attention turns to what happens in Europe, where they're having a big meeting on the 6th, which is this week, to see if they're actually going to do some stuff that will help Spain and other countries there. Then they have a big meeting the week after that, also in Europe. So there's a bunch of things that seem to be stringing investors along, and they're just going to keep pinning their hopes to this, that, and the other. But no one dares short the market at this point because Ben Bernanke, he keeps opening a crack and saying, I can unleash this quantitative easing at any time. So don't mess with me. And so all the shorts say, we're not going to mess with you.
Yeah.
And so that kind of really takes some of the fear out of the market. It has been extremely light volume, this rally, but the volume seems to be there today, not humongous volume, but more volume than we've seen recently. So we'll really have to see how things shape out next week. But I actually took some gains going into this meeting because I didn't know what the heck was going to happen. So I'm sure that my subscribers are just ready to kick my butt. But I have a lot of other positions I can add, and so we'll be adding those on pullbacks and stuff.
Let's talk about the real news as we head into the Labor Day weekend. U.S. gas prices up almost 50 cents a gallon since the summer started. Gallon a regular now, almost $3.83. I guess we can blame Hurricane Isaac for this one. The refineries, 8 refineries, 500 oil rigs off the Gulf Coast affected. That's got to affect the price of gas, obviously, right?
Well, it does and it doesn't, because gas prices were already going up anyway. In fact, the rise in the futures market is much bigger than what you've seen at the gas pump yet. At the gas pump, that usually lags the futures markets by a few weeks. That's going to take some time to work through. So even though Isaac didn't turn out to be much, you're probably going to continue to see gas prices rise at least for a while. There are a bunch of forces that are actually acting on this. One is that U.S. refiners can ship fuel, all over the world, China, South America, stuff like that, and they're shipping more and more of it. In fact, fuel shipments from U.S. refiners overseas is up 50% year over year.
Wow.
And then we just had the big refinery down in Venezuela blow up. That was a huge refinery. I assume they'll start making gasoline again sometime, but it's probably not going to be soon. So that puts pressure on like the regional prices of gas because, they have to buy from us when they can't make it themselves. There's a lot going on in the markets. Certainly, Isaac was an excuse to raise prices maybe at the gas pump, but it's going to have less effect than these other forces that I'm speaking about. And one force that we have to keep in mind is what if the Fed eases again?
Yeah.
Because when the Fed does that, that tends to drive up the prices of all sorts of hard assets. That's why we're seeing things like gold and silver take off. That helped put a real fire under the price of oil today. And so if we do get more quantitative easing from the Fed, that will push prices higher no matter what happens out in the Gulf of Mexico.
As we feel the pain at the pump, we can also make some money in the energy sector. How do we do that?
Well, in my recent video, which is up on the uncommonwisdomdaily.com website, I was talking about a trade that I did in my Global Resource Hunter, which is a monthly newsletter I have, which is we have Valero in there. And, it's just doing extremely well and looks like it's going to continue to do well. This is one of the refiners that ships all this fuel all over the world. But it's not just Valero. The whole refining space is actually a very good place to be. Find one that pays a nice dividend because that's also a good place to be in a time of easy money. What we heard from Ben Bernanke is that he is going to keep money cheap for a long time regardless, right? So in a time of very low rates, those stocks that actually pay nice dividends do well. That's why those stocks that pay nice dividends have done really well for the last 6 months. But they should continue to do well. If you find a refiner that pays a nice dividend and also has exposure to the global markets, that's one that could do very well in anyone's portfolio. That said, no one should buy anything just because some guy on the radio talks about it.
What?
And everyone should do their own due diligence before they buy anything and have an exit plan before you buy anything.
I promise I will, Sean.
All right.
Sean Brodrick from Uncommon Wisdom Daily. Good times for gold and silver, especially silver, up over 31 again at its highest point since May. And you're talking about 3 facts and a rumor that are moving gold and silver. Let's talk about fact number 1, that people are starting to stock up on silver.
Yeah, well, actually, before we do that, we should mention that on Friday, after Ben spoke, we saw silver pop, and that pop was enough to give a monthly buy signal on silver using a system that I use.
Okay.
And I can't be the only one using that kind of system. There are many technical analysts out there in the market, and so that means people who were short had to cover, and other people are actually adding new long positions. So that's one thing to really keep in mind there, that there's some good bullish signals in the market right now. And so I think that that's one more force that we'll have to add to the market, and that's one more thing to actually keep in mind. But to get back to the point you made, this is from a column that I wrote for uncommonwisdomdaily.com. Yes, investors are stocking up on silver. We are seeing investors add to their holdings in the SLV, for example, funds that are easy ways to hold silver. And so these seem to be mom and pop investors, many of them. And so this is actually a very bullish sign for the metal.
Not just silver, but platinum and palladium. They're also going crazy.
Well, yeah, platinum's a very different story, though, because down in South Africa, they are having strikes at the mines that have turned into riots. It's a long, complicated story, which I won't just, bend your ear on it, but they've had some real unrest at those mines that actually produce platinum down there, and that's one of the major sources of the world's platinum. Are those strikes over? For a while, people were thinking they were, and then there started to be a little more violence, and so who knows at this point. That's really putting a lift under platinum and is something people should keep their eyes on.
Sean, what about the seasonal aspect here with gold and miners?
Well, yes, seasonally. I mean, the last half of the year is just usually a great time for precious metals and miners because of all these festivals we have around the world, India and China. Here in the U.S. also we have Christmas, and actually pretty much all the Western world we have Christmas. Seasonally speaking, it's a good time to be long, and I think this is when we could see gold, which looks like it's breaking out, just like silver's breaking out. This is when we could see gold make its run to $2,000 an ounce.
Okay.
It would surprise me if we don't see $2,000 gold by the end of this year.
Sean Brodrick from UncommonWisdomDaily.com, our guest here on This Week in Money. Now for the rumor that you're one of the few people talking about this. Tell me about the rumor about China and gold. This is fascinating.
Oh, well, rumors are rumors. And everyone hates to give any credibility to rumors, but the fact is the market trades on them.
Sure.
That's the thing, because, this market is so hysterical that when you get rumors and stuff, sure enough, it can push the market around. And the rumor is, and it's unconfirmed speculation, so don't go telling people Sean Brodrick said, so it must be true. But it's unconfirmed speculation that China, which is the world's number one producer and second place consumer of gold, is gearing up to buy at least 5,000 to 6,000 metric tons starting before the end of the year. Now, considering that global gold mine production has averaged roughly 2,600 metric tons per year over the past 5 years, you can see China's potential purchase is a lot of gold. Also, WikiLeaks just released some kind of secret cable showing that, in fact, China may be adding to its central bank holdings of gold. So you see all these things, and you can see how there really is the potential for that kind of thing, if it pans out, if it is true, to really be supportive of the price of gold. In fact, considering how negative and how bearish many analysts and many Wall Street traders, many global traders got on gold recently, the fact that it didn't go lower is indicative of central banks somewhere picking up a lot more of it, using that pullback to add to their gold positions. And so now if people start to turn bullish and the central banks keep buying, then $2,000 could be a lot closer than anybody thinks.
Yeah, China may be the big market mover here, but let's not forget that countries like Kazakhstan, Mexico, Korea, they're all adding, central banks, they're all adding to their gold stocks.
Right. The reason everyone obsesses on China is, A, because they don't own very much compared to what they should own if you look at them compared to other countries, because they have these huge foreign reserves, and a larger part of that should probably be gold. Also, the other reason is because you never know what China does until after the fact, and long after the fact. So that's why everyone speculates about China, because it's very hard to know exactly what's going on there.
Sean, a great time to slip in a plug for Red Hot Global Resources. How's that going to help me make intelligent decisions in the future?
Wow. Boy, that's putting a lot on a poor little newsletter, plucky little thing that it is. But you know what? We just grabbed 4 rounds of gains in Red Hot Global Resources, and as I said, I'm sure I have some subscribers who are unhappy with the fact that we grabbed half gains on some positions. But they got the other positions. Everything is in the green today, and I'll be adding new positions next week. I tend to focus on small caps. It is focused on natural resources. I think that's a great place to be in the market right now. That is Red Hot Global Resources. The other publication I have, which is a monthly newsletter, much less expensive, called Global Resource Hunter, also focuses on natural resources, but it has more of a let's find stocks and funds that pay very nice yields. So you're getting the big push from natural resources. You're also getting big fat yields that can pay you quarterly and sometimes monthly. So that's a nice little thing to have. Also, it just really helps perk up those returns.
UncommonWisdomDaily.com is the place you want to go. And we always, because it's Labor Day, it's the weekend, we always look for fun angles here. And I got 2 contrasting headlines here. Maybe you can figure this out. See if this is a coincidence or not, Sean. Headline 1, Diet Pepsi seeking sweeter formula. Headline 2, millions of dollars in maple syrup stolen. You think there's a connection there?
That's maybe they are the maple syrup thieves. That would explain a lot. And yes, that's a lot of maple syrup that got stolen up in Canada, which immediately when I read that story, I'm there thinking, how big is the black market for maple syrup? Do you have maple syrup runners? What's going on with that? That's crazy. But your neighbor to the south, the United States, has the biggest sweet tooth of just about anybody, doesn't it? So if it was stolen, yes, it was probably sold south of the border in these sleazy United States maple syrup speakeasies where they sell hooch. They would sell maple syrup hooch in a maple syrup speakeasy because, that must be what's going on. How else do you explain that massive theft that we saw up in Canada?
I guess the smoking gun will be when they introduce Diet Pepsi Maple.
Yeah. Well, you know what? Pepsi owns Taco Bell, which is now rolling out their new tacos made from Doritos. And this apparently is the most successful launch they've had in their 50-year history.
Wow.
What is the secret ingredient in those new tacos? You have to wonder. Maybe it's the maple syrup. I don't know. But certainly they are feeding America's sweet tooth. So, yes, I think you are on the button. We should interrogate them immediately, and if they don't have the right answers, we'll send them to Gitmo. Absolutely.
Sean Brodrick is editor of Red Hot Global Resources and Global Resource Hunter. Check out Sean's blog at uncommonwisdomdaily.com. And you can also find Sean on Twitter at Sean Brodrick. Hey, Sean, it's always fun, and have a great Labor Day, my friend.
Hey, you have a great one, too. And certainly my best wishes to all my friends up there. I will be up in Toronto next month at the Money Show, which is going to be a lot of fun. So if anybody's in Toronto and they just want to speak to someone there, come by and say hi to me, because I'm always happy to talk to people, and that's a lot of fun.
Come for the conference, stay for the maple syrup.
Yes.
Thank you, Sean.
Thank you.
This Week in Money is archived online at talkdigitalnetwork.com.
Adrian Ash runs the research desk at Bullion Vault, the world's largest online investment gold service. He is online at bullionvault.com, and he joins us today from London, England. Adrian, it's always good to have you back on This Week in Money.
Hi, Phil. How are you doing?
It's been a quiet summer for gold without a lot of fanfare. It reached a 4-month high last week, mostly on chatter about stimulus, both the Fed and the ECB talking about stimulating the economy. And has that been the only thing behind the rise of gold? What else is going on?
You're absolutely right. It has been a typically boring summer in gold and silver. I mean, traditionally, the gold and silver markets take a holiday right at the right time in July and August. People, they look at 2008, they look at 2011 in particular, of course. Last summer, we had all-time record highs above $1,900 in gold. But this is, very much the normal pattern that we see. We just had the last of the summer bank holidays here in London. I know you guys over in North America, there's Labor Day in the States, I think a week today, so that's Monday the 3rd, and then it's back to school for everybody. Very typical to see gold kicking higher from here. I think, yes, there's a lot of, we're starting to call it quanticipation now. It's kind of anticipation of quantitative easing, which we've seen a few times over the summer, actually. When gold has got to the upper end of that range, which it finally broke through last week, it's come on anticipation of the Fed doing something or maybe changing their wording, which is what they did last week. So, for the Fed to have gone from saying, we'll only consider doing more QE if the data deteriorate, to what they said in the latest Fed minutes, which was, we're going to do more unless the data significantly improves. I think that is a big switch, and I think a lot of the bigger players in the gold and silver markets are looking at that and taking that as being a green light on more QE to come. We had some comments out from Fed officials over the weekend as well, saying that it's not just a political decision. They're not going to be bound by when the election comes in November. I'm still not convinced. I got a feeling that the Fed has become a very political thing. Even more political thing, should we say, over the last couple of years. And I think to do any more QE before the election would really invite a lot of criticism
Adrian,
from the U.S. media. So, my money would still be on wait until November, but I don't think gold and silver are going to wait. We've seen that over the last week now. And I think, that quanticipation is really kicking in now.
Interesting, the difference in the mixed messages we're getting here. What a difference a day makes here. Here's a Bloomberg from yesterday. Gold set for best year since 2010 as stimulus bets increase. This morning, gold drops on speculation Bernanke will refrain from stimulus. It really isn't clear which way we're going here.
And gold is on he's on a hair trigger. I mean, gold pays you no interest, but it is always a speculation on monetary policy. So I think, as this summer has proven, as I said, with these little pops that we've had in gold and then disappointment every time the Fed have spoken or there's been a Fed meeting and they've done nothing. What you've had is really proven that gold is the most sensitive investment asset to interest rate expectations. It's more sensitive even than, T-bills.
Yeah.
Because what a central bank does to its currency is immediately shown in the gold price. So anticipation of that is what's really been moving the gold price higher and lower. And that's fair enough, I think, because over the last 5 years, Phil, central banks have taught us that, they are in control of how things work and they're going to fix everything with more money. So, just hold on and they'll sort it out. Gold has clearly gone higher on that monetary inflation. I think another key factor, however, in the longer-term gold story has been the other side of the coin, if you like, which is deflation. The destruction of money brought about by bankruptcy, by banking defaults and so on, creditor defaults. So I think what you've got there is, that's really what's driven the underlying story in gold. I mean, just here in the UK, September is going to mark the 5th anniversary of the banking run on Northern Rock.
Mm-hmm.
And that really, was the bleeding edge of the global financial crisis, if you remember. Now, at the time here at Bullion Vault, we saw a really strong uptick then in new customers, new account openings, new deposits, and new gold buying, and that was really driven not by fears of inflation, but by fears of the opposite course of deflation, of depression, and so on. Because the banks might go under. I mean, this was the first time we'd seen a banking run. Queues on the high street here in England. People lining up to get their money out for the first time in 100 years. Which reminds us that our banking system is no stronger or more fragile than it was back in the Victorian days. That banks can and do go bankrupt. And that if you have money on deposit, you are a creditor, you are on credit risk. And I think that's been, a very big part of the story. People normally associate gold and silver investment with an inflationary fear, which is absolutely true, but gold and silver prices over the last 5 years have benefited from the other side as well.
We're coming up, Adrian, on the first anniversary of $1,900 gold. September 6th, 2011, $19.20 per ounce. And today around $16.70 or so. It's been a heck of a journey, hasn't it?
Absolutely. I remember last summer very well. I was actually away on holiday for the 2 weeks when things really got moving. When I came back in the middle of August, the price had put on $200-300 since before we went away. Absolutely crazy times. And increasingly crazy compared to the previous peaks that we'd seen in new business and activity here at Bullion Vault of 2008 when Lehman Brothers went, and before that Northern Rock here in the UK in particular. I think last summer you had very much the perfect storm for gold. You had obviously the US debt downgrade. I think that was very significant because it really did finally put albeit plainly obvious chink into the dollar status as a reserve currency. It was finally recognized by the ratings agencies. You also had obviously the European crisis hitting a whole new phase from which it hasn't recovered yet. I mean, the European crisis just gets worse and worse the longer the can is kicked down the road. You also had English towns in flames. We had rioting pretty much across the UK. And so you really did have this kind of, this confluence of all these factors coming together, which made gold a very attractive investment for people who were frightened about their money. Yeah. And as I said earlier, I think that's really what's driven so much of the gold investment move over the last decade, and particularly the last 5 years. Where do we go from here? I think there is a case to be made that, we'll see a break of 19, maybe going into $2,000 per ounce, only when the crisis gets even bigger and even uglier than it was last summer. It won't be a pretty place to be. But I do think that, today's buyers and those people who bought last summer and are still holding out to get back to break even, I think that's the concern. You could look at gold as being a losing asset over the last 12 months, fine. But whilst you have been on price risk, one thing you don't have when you own physical gold and silver outright is you don't have the risk of an absolute loss. I mean, this stuff never goes to zero, never has done in history. We'll always have a deal price. Now, you can't say that of debt investments. You can't say that of equities. You can't say it of cash. You can't even say it of real estate. I mean, if you're a real estate investor, let's say in Ireland, and you bought a row of flats or apartments as an investment a couple of years ago,
ouch,
they may well have gone to zero on you now because you can't sell them and you can't borrow against them. Now that's never happened to gold and silver. And again, that's when you're buying gold for your investment portfolio with a chunk of your savings. I think what you're getting there is you're getting something other than just the hope of price appreciation.
Adrian Ash from Bullion Vault, our guest here on This Week in Money. Here's an amazing stat for you, Adrian. Gold has doubled in value since the first QE 4 years ago. Now, what happens if the market perceives that all this stimulus is not enough? What will that do to gold?
Look at the ECB. I mean, the expectation now that the European Central Bank is going to have to join the party. It has done to a great extent anyway. It's swollen its balance sheet dramatically over the last few years now. But will it formally go out and say, okay, we are now printing money. We are going to be buying weaker Eurozone government debt to prop up the prices, to cap the yield that this stuff is offering people, so that governments can refinance at a lower price. That seems to be the latest discussion, and you're getting rumours and counter rumours all the time on that now. I think the bottom line remains with the way that governments and central bank policymakers are trying to find a way out of the crisis, which is now celebrating its 5th birthday, is they're either going to have to default, they're either going to have to, basically say, a la Greece, no, we're not going to pay back our creditors, or to avoid that, I think the far more likely option is they will devalue the currency. So QE, I think, remains very much on the table. Okay. I think we are going to see a mutation in actually how it's proposed and how it's put forward. Quantitative easing, if you look at the Bank of England, for instance, which has done a phenomenal amount of QE. I mean, it now owns, I think it's getting on for 25-30% of the outstanding UK government debt market. It's now got that sitting in Threadneedle Street. It was at pains when QE was launched to say this is not money printing. Sometimes people call it money printing, which is wrong because we're not printing money, and technically that's exactly right.
Okay.
They're printing digits and zeros on a screen instead. I do think if you look at Operation Twist, that was a definite plan by the Fed to try and dissociate its latest actions from quantitative easing, aka money printing. So I think we are going to start seeing maybe some new weird and wonderful innovations in the QE world. But the bottom line remains monetary stimulus is very much to the fore. And again, looking for instance at the UK, and I think the same is true for the US now, you've actually had this very strong rally in the pound, just as you have in the dollar. And of course, that doesn't suit the domestic governments who are in control of those currencies. Very much like the 1930s, it remains with economic activity depressed. Each individual country is going to be looking to try and maximize its share of the shrinking pie. And route one to that remains trying to devalue your currency to try and make your exports more competitive. We've seen Japan do that time and again over the last 10, 15 years during its own depression. The global depression has only worsened that problem for them. So I do think, we're going to be having this problem again of governments looking to actively devalue their own currency. But it may well come under new names.
We're talking to Adrian Ash from Bullion Vault here on This Week in Money. The other big U.S. news story this week, the Republican convention, Mitt Romney's platform could include a return to the gold standard. How would that work, and what would that do for gold?
Well, I don't know how I know how a gold standard could work. I don't think it's got anything to do with how Mitt Romney's GOP, to be blunt, are actually going to put it forward. Yeah. Look, the best informed contacts we have in the States agree with us that this is very much a political sop. It's not being offered as a genuine step forward in any kind of return to a gold standard. If you look at the last time this was actually put onto a political platform, was back in 1980. And then again in 1984, it was actually on the platform for Reagan's re-election campaign in 1984. The first time round, the word gold wasn't mentioned, but monetary stability was spoken about a lot. And what's interesting, in that first platform in 1980, the Reagan Republicans said the government, Jimmy Carter in particular, should leave the Fed alone to operate monetary policy as it sees fit, and that we need independence of the central bank so that we can get on with defending the currency and having stability. What's very interesting is that after 4 years in power, and after 4 years of Paul Volcker at the Fed pulling on the levers and raising interest rates to try and kill inflation, the 1984 platform then said what we need is a less independent central bank who doesn't try and screw around with everybody's economic policies. So, yet again, the Fed then was, a very politicized institution. Interest rates, of course, were, up at double digits. And that's the big difference now. If you have interest rates which are above the rate of inflation, so cash in the bank is actually paying you a real return, you don't actually need a return to gold. That's not really, the gold itself in the gold standard was just a conduit. It was just a stepping stone really into having better managed currency, which really starts with what you do with interest rates. If you have interest rates which, as they do now across the world, interest rates that are below the rate of inflation, it means that you are punishing savers. You are trying to reward debtors, but at the moment, of course, debtors can't get credit anyway because of the way the banking system is. So you end up with the worst of everything now. And I think that's really what the call and people's ambitions for a return to gold is really about, is actually having a monetary policy which doesn't just appeal to sub-zero real rates of interest every time there's a problem. I think that's really what the debate should be about. I think the return to gold isn't going to get anywhere as a discussion, quite frankly. It's just the first thing. You've seen it this week as well. Paul Krugman, the arch nemesis of most right-wing thinking people, coming straight out and saying, this is a terrible idea. Look at the 1930s. Well, if you look at the way the gold standard was being run at the dawn of the 1930s, it really didn't have much relationship to the way a classical gold standard worked anyway. You had, various actors were hoarding more than they should have done. You had the Bank of England lying about how much gold it was bringing in and how much it was letting out on a week-by-week basis so that they could then try and hoodwink the politicians into allowing them to change policy a little bit. No one was playing by the rules. And the problem with the gold standard, if you return to it, is it'll just be thrown over again as soon as it becomes expedient to do that.
Well, we're talking about gold. We have a couple of minutes left. Tell us how a Bullion Vault works and what your service does for people.
Well, Bullion Vault basically is an online exchange for private individuals to buy and sell physical gold and silver. The gold and silver is vaulted in professional specialist vaults. It takes the form of large, good delivery wholesale bars. These good delivery bars are the way that the wholesale professional market globally buys and sells physical bullion, and our customers get to transact in that market. You can name your own price, so you're operating in a live real-time market. It's with matched orders. It's all limit orders, so you put in an order to buy at $16.20, you will not pay $16.25. You may well pay less than $16.20 if that's the price that goes through when somebody matches your order. So it basically means that we've got very competitive prices on the Bullion Vault order board. When you look at Bullion Vault's market order board, you're not looking at a dealer's spread between the price to buy and the price to sell. You're looking at a market spread. It's our customers' prices. That's what our users are looking to buy and sell at. So you can go in as well and make your own price. If you want to pay a little bit less than the best offer at the moment, or you want to sell for a little bit more than the best bid currently is, then you can do that, no extra charge. We eat by charging our customers a dealing commission, so effectively we're operating just like an exchange. You pay for using the order board. And then the gold and silver is yours, it belongs to you outright, which is very important. It's fully allocated inside the vault. Now, it's actually a very simple business. All we're doing here is we're bringing IT innovation, a software innovation, to enable ordinary private individuals to use the order board like this from wherever they are in the world. We don't innovate in custody at all. The custody, as I say, is taken care of by professional specialists. These are the guys who, this is what they do. So we leave them to do that. There is a small custody charge to pay, of course. That's a minimum $4 per month on gold or a minimum $8 per month on silver. And we've now got 40,000 users, 41,000 users now worldwide. I think we've got 159 countries where people are using Bullion Vault. And I believe we're pretty much the biggest on the internet at what we do for gold and silver. And we've, as I said earlier, it was a pretty quiet summer, as it was across the gold industry. Actually, the gold and silver markets worldwide were very quiet. But we've seen, in line with the price move over the last week or so, we have seen a definite upturn, a definite return to school for a lot of our users. We're seeing new account openings turn higher as well.
Adrian Ash runs the research desk at Bullion Vault, the world's largest online investment gold service. He is online at bullionvault.com. Adrian, thanks for this, and I wish you a golden summer and fall, my friend.
Thanks very much, Phil.
Thanks to our guests, Ross Clark, Sean Brodrick, and Adrian Ash. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.